The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to Nova's presentation, Common 401k Plan Errors with Steve Vest. Before we get started, I would like to point out the panel on the top right-hand corner of your computer screen. You're going to see a drop-down section for chat. This is where you're going to enter in any questions that you may have for Steve. Feel free to submit your questions at any time. The Q&A portion of this session will be held at the end. If time runs out and you still have questions, you can send them to our email address, webinars@nova401k.com. Right below chat, you will see the handouts drop down. Here you will be able to download today's material in PDF form. If you are unable to view or click on the handout, go ahead and send us an email and we can provide you with that PDF. If you're with us today to earn continued education credits, please be sure to stay until the end to fill out our pop-up survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us today. I would now like to introduce Nova's VP and shareholder, Steve Vest.
All right, good afternoon, everybody. Sorry about the technical difficulties. I will try to move a little more quickly through some of these slides just so we stay on time. Quick disclaimer that none of what you're about to hear is intended to be legal or tax advice, and if you need that kind of advice, please call a qualified professional like an attorney or accountant. Nova's provider number is 009820. You need to have registered individually, be present for the whole webinar, return an evaluation form, and you'll receive your certificate in 1 week. So some of the objectives we have today are to learn to identify who and who is not a fiduciary, to also identify some of the more common problems that relate to 401k plans that we see in our practice, as well as what the IRS has identified as some of the more common errors, and then how to avoid them, and then how to correct them. So I'd like to start off with this slide just to initially talk about our role in servicing your plans. It is what we call an unbundled role, so we are carved out as being the compliance specialists that prepare and maintain your plan document. We handle all of the preparation of your required IRS testing, your IRS form filing with the Department of Labor, and the ongoing consulting that you need to operate your plan in conformance with the IRS and Department of Labor rules. You guys are the sponsor, right? And part of your responsibilities are to send in the contributions that participants elect out of your payroll and get them over to the investment provider, which is in the lower left corner. And we deal with a bunch of different providers. Your plan may be with Hancock, Principal, Voya. We've got about 10 different partner firms that we work with. And they're the ones that actually provide the mutual fund platform, the 1-800 access, all the investments. They'll handle the distribution processing, the tax forms that go along with those distributions, and then keep track of all the money, basically. And then neither us as the TPA or your investment provider can provide investment advice or really help your clients with how to allocate their portfolios. So I say clients, your employees. And so your financial advisor that's attached to this can help with those types of services. And so together, the three organizations provide services to the plan sponsor. So why is all of this important in terms of what we're going to talk today? What we see is operational plan failures, which are basically the failure to follow the terms of your written plan document in actual practice. So these types of operational failures are much more common than investment-related losses and lawsuits about, how much the earnings were on the mutual funds and so forth. And they can result, these operational problems can result in substantial penalties and fees to fix them. And as fiduciaries, you bear personal liability in some cases for breaches and losses. Not all of the problems we're going to discuss are considered fiduciary breaches. You know, they're just operational mistakes. So don't get too terrified about that statement there. The Department of Labor keeps statistics on penalties, fines, and restorations. As you can see, over the years, they've been collecting, you know, these types of fees and penalties throughout some of their different correction programs. Right. Also, a few years ago, the penalty for missing your 5500 or missing certain form filings with the Department of Labor and the IRS have gone up substantially, like a 10-fold increase. So, and we do see the IRS and the Department of Labor imposing these types of penalties when certain things go wrong. So, again, important to avoid these mistakes that we're going to be talking about. Now, all mistakes can be corrected. You know, no one's going to 401k prison over making them, but there can be costs involved. The IRS has a correction program that involves 3 parts. There's a self-correction piece of it where you don't have to do any formal filings with the Department of Labor. You can fix the problem pursuant to their principles that are in the program, right? They have a lot of examples on how you fix different issues, but you can fix them on your own and you don't have to pay any additional fees or anything to the IRS to do that. Now, depending on the error, you may have to do a voluntary compliance program filing. This is an official filing with the IRS to ask for a correction to be approved by them, and then they would issue a compliance statement. And if you're ever audited by some other agent of the IRS and you pull out the compliance statement, you can just show them, you know, this has been fixed and we had your approval. So now if you get caught and you had a problem, you didn't self-correct it or go through VCP and you just get caught outright on open audit, then there's the audit correction program available for correction, but these normally involve higher penalties generally. So they'll impose a punitive penalty on top of just the correction amounts that you might owe. So to use the VCP program, it's just based on how much money is in your plan at the end of a particular year. And most plans fall within the 500,000 to 10 million range. So if we had to do a VCP filing for you, which is something that we can do here at NOVA as well, you would have to pay a $3,000 filing fee with the IRS in addition to any contributions that you might owe for the correction itself. So who is a fiduciary? ERISA defines 3 different types. We're not really going to talk about the first 2 because those are related specifically to the investments in the plan. Today, we really want to focus on what we call the 316 plan administrator, because that has to do with the actual operation and administration of the plan. At a high level, though, a fiduciary is defined as any individual or entity who exercises any discretionary control over the plan administration or over the plan assets or renders investment advice to the plan for a fee. Okay. Examples of that would be your investment advisors, typically the trustees that are named in the plan documents that govern your plan, the investment managers that handle the mutual funds behind the scenes. If you have an administrative committee, all the members of that committee that are making decisions are fiduciaries. And then the actual administrators of the plan. So somebody internally at your company that's handling the distribution approval, the sending in of the contributions, so forth, you know, making discretionary decisions. If it's simply a ministerial act, you know, I guess like sending in the contributions wouldn't really make you fiduciary, just because that's not really a discretionary act. You're just like sending in money. But any people who hire or fire any of the above, right, would also be a fiduciary. So the 316 fiduciary specifically is defined as the plan administrator. This is typically not a person named in the plan document. It can be, but all the documents we draft don't actually name who the plan administrator is. Again, specifically like within your firm, you know, Tom Jones is going to be the plan administrator, because people change in and out, right? And that would just not work in a plan document. So they're not typically named, but it is going to be the person that is responsible for managing the daily operations of the plan. That individual is going to be a fiduciary, and specifically the 316 fiduciary. So you might ask, well, but my investment provider like John Hancock or Voya and Nova handles most of my plan administration. Aren't we fiduciaries? And the answer is generally no, we're not. We're just providing ministerial functions. We're not fiduciaries. Our contracts indicate that too. So we help you prepare we do prepare the 5500, but you sign it. We do prepare the non-discrimination testing, but your responsibility is to review it. If there are refunds that have to be made because testing failed, you're signing, what we are giving you. So because of, we're not actually making discretionary administration decisions, right? The signer is the one generally is going to be the fiduciary. So we're just helping provide the consulting and doing the work that you all ultimately review and submit. Such things, duties of the plan administrator, again, which is you, right, involves distributing annual notices. There are certain the summary plan description is the 16-page layman's explanation of the plan document, right? There's a legal plan document with all the provisions. And a summary plan description comes with that, which you have to give out to participants. Not every year in this case, but when they're newly eligible or whenever there's a substantive amendment to the plan, those have to go out, and generally neither our firm nor the investment providers actually mail those out. Okay, a lot of, some of these other things you might get assistance from in terms of the notices. From your investment providers. So they might send out some of the fee disclosures and whatnot, but they generally don't send out everything that's legally required. So again, approving loans and distributions, generally going to be one of your jobs. Maintaining an up-to-date legal document. This is where we keep track of that for you, and we send you plan documents for review, but ultimately, it falls to you to actually sign them, right, on time. One of the most important, enrolling your newly eligible participants on time. We'll talk a little bit more about that one. Sending in the contributions, etc. So one of the first mistakes that we do see is employers are required to amend their plan from time to time to keep current with new laws that are passed by Congress. And just recently, Congress has been very busy passing new laws with the Secure, 1.0 Act and also the Secure 2.0 that made sweeping changes to the 401k plan rules. And again, we do communicate what some of these changes are and make sure that we keep your document drafts up to date, but just keep an eye out for interim amendments, a restatement every 6 years. The IRS issues new template documents, okay? They're pre-approved, and so long as you don't fill in outside the blanks, you can rely on the letter that comes with them that you have a qualified 401k plan. However, if you don't sign them on time, then there's a different problem. So that happens every 6 years. We keep track of when interim amendments are due, when these major restatements are due, and we send out anything that you're required to sign. So it's not like you actually have to know when all these things are due. We will keep track of that. The key is when you see our emails about signatures, required amendments, and so forth, it's very important to pay attention to those and make sure the documents are signed by the deadlines that we give you. So failure to sign up all affiliated employers. I wonder if this is skipping. It looks like. 1 second. Yeah, so sorry, I'm going to use the scroller. So failure to sign up all affiliated employers, sorry about that. Only companies, another thing to keep in mind, only if you have more than one company that's in your control group, which we'll define here in a moment, but you may have subsidiaries, other companies that are related to your company that actually has the plan. The way our documents are, you have to sign up all those extra companies. So if they have not signed up using a participation agreement, they're legally not able to participate in the 401k plan, in your 401k plan. So if there are some other companies, make sure that they have participation agreements. Failure to sign up all affiliated employers. Again, all companies within what we call a control group generally need to participate in one plan. All right, and there's two different types of control groups. One is called a parent subsidiary control group. So this is when one company owns at least 80% or more of another company. The IRS views those two companies as a single company, and you would generally have them both signed up for the plan and both eligible to participate in the plan. The other type of control group is ownership by individuals. So when you have the same 5 or fewer individuals commonly owning 80% or more of two companies, again, you have a control group. It's viewed as one company by the IRS. So how do we avoid the failure to sign up all the participating employers or amend your plan on time? Just make sure you're paying attention to our correspondence. We send out a lot of reminders, sometimes irritatingly so, but it's in an effort to make sure that you don't miss any deadlines and we keep you out of trouble with the IRS. Also, if you have extra companies, even now, if you're aware of subsidiaries that fulfill those control group rules and you don't think you're offering the plan to those companies, you should probably call us immediately so we can do some Q&A and find out if it's really required that you do or not. And then certainly anytime you're either selling your company or one of the subsidiaries or being acquired, I would highly recommend that you contact us ahead of time, because your options become very limited if the transaction goes down and we hear about the acquisition after the fact. All right. And then based on these emails we send you, make sure that you're executing them by the deadlines we give you. Failing to follow the provisions of the plan document. So your plan document comes with an adoption agreement. You've probably seen them that have all these little blanks that define the specifics of your plan. What is the waiting period? What is the vesting schedule? What kind of employer contributions have you committed to? The IRS requires that you follow that written plan document in actual daily practice, and not doing so can subject the plan to what we call disqualification, where they retroactively take away your tax qualified status, and that can result in quite a few penalties and taxation on all the participants. That said, in my experience, I have not seen the IRS disqualify many plans because it is harmful to the participants. They just generally make you fix all the errors, which can also be expensive. So in this plan document, there is a definition of compensation. And what we find is sometimes employers in their payroll systems are using a different definition for applying both the employee contributions and any employer contribution calculations that you might have, whether it's a match, usually it's a match or profit sharing, right? And this can result in participants getting the wrong allocations. Now, just so you know, our plans and NOVA generally define your plan compensation as total gross pay. Excluding bonuses, commissions, overtime, it's okay, but that has to be written into your plan. It may be, I should say, it may be okay. It depends on the amounts involved. And then your document also has to say that those types of things are excluded. So if you think that your payroll system is not using gross pay to define, how much people have taken out of their checks, I would contact your NOVA account manager, and we can take a look at your document and how it says you should be doing it, and compare to your payroll records to see if that's actually happening. Yeah. It's just a basic example, right? If you had a company that has a matching formula and the payroll system is using base compensation, excluding overtime, but the document indicates that it should be total gross, we have a problem, right? Because people have been under contributing right? And what we would have to do, this kind of a problem is self-correctable, generally speaking, but you would go back and look at that exclusion that's not permitted and what the person elected, and then you'd have to pay them the difference plus any match if there was one going on in your plan. So depending on how many years that might be happening or the amounts involved, I mean, it can get very expensive to fix. Again, to avoid this, you need to know what your plan document says about compensation. What is your plan's definition? And then compare it and run some test calculations in your payroll system to see, is the payroll system, if it's gross comp, is it using the top line number, right? Or is it using some net number that excludes bonuses, commissions? And then just call us. We can definitely help. We have a special projects team that does these corrections if one is needed. So we can't help, but just be aware of what your document says and what you're doing in practice. Failure to essentially follow the initial waiting period in your plan. So this falls to this issue of letting your people in on time. And on time is whatever your document says. Doesn't matter what any HR policy says or any offer letter that you might have made an executive. If your plan document says we got a 3-month wait or a 1-year wait, you can't just let people in early because you want to, all right, or because some other administrative manual says that you were going to do that. Those things are irrelevant. So we do find all kinds of, we find both sides of this, right? Some employers we found will let people in early, and some people, let them in late, and both can be problems that need to be fixed. So for example, if your plan has no age or service requirement, but Steve is not offered enrollment for 6 months after they're eligible, then the fix is you would have to determine what is that compensation that for the exclusion period, for that 6-month period that he should have been allowed to contribute on, and then the employer is going to have to make up the missed contributions plus earnings and any mismatch if your company was making a match. So just so you know, there is a maximum waiting period that plans can apply. And I always like going through this slide because I'm not sure employers understand how the 1-year waiting period really works, and it's important. I know some of the plans have less. Some of you on this call have a shorter waiting period. That's okay, but the maximum is age 21 and 1 year of service with a minimum of 2 entry dates. Okay. Typically, a certain number of hours may be required, and usually are. That number can never be more than 1,000 hours. Right. So how do you count a year of service? A year of service is the year in which you work 1,000 hours or more. Right. Age requirement cannot exceed 21. And this is, I'll show a graph on this last bullet, but the initial computation period to determine, whether somebody has achieved 1 year of service begins on the initial date of hire, the very first one, and goes to the 12-month anniversary date from the original date of hire. And if they didn't work 1,000 hours, it then changes to the calendar year. This is a part where people may get confused. All right, so looking at it this way, if I have somebody that hires on 6/1 of 2022, my initial computation period is the 12-month anniversary date, so 6/1 of 23 right here, right? And I'm looking and asking the question, did this person work 1,000 hours or more in that period? And you can see across this calendar years, right? If the answer is yes, they get credited with 1 year of service on the anniversary date. Not the minute they worked the 1,000th hour, but on the anniversary date. And then if I had 2 entry dates, typically if it's semi-annual, most plans are calendar year plans, so let's say it's 1/1 of 23 and 7/1 of 23. This person becomes eligible 6/1. You would offer them the plan maybe a month or so before the 7/1 entry day so they can make an election, and you can get it into payroll for the first pay period beginning after 7/1 of 2023. Now, if somebody does not work 1,000 hours in this period, what I was talking about before, where the period switches, right? Let's say they work 500 hours. So they didn't get credited 1 year of service in 23. The next period you would look at to determine if they met the 1,000-hour requirement switches to the calendar year. Now, why do we do that? If you had to, you might have 100 employees. If you had to track non-calendar year periods for hours purposes, that would be incredibly difficult for 100 people, right? Or even a few people. But, if after the first computation periods, this is legally required, this period. This one is there to make life a little easier for you. So if they don't make it on the first computation period, you switch in the next year so that it's on a calendar year basis, a little easier to manage. Shorter periods, as I mentioned, are fine. So 1 year is the maximum. You can have everything from immediate entry to, we see 1 month, 3 months, 6 months are very popular. Those are probably the most popular shorter waiting periods. That's perfectly fine. Just keep in mind that shorter waiting periods are not effective for keeping part-time employees out of your plan. All right. I know a lot of plans are getting into trouble by excluding part-time employees, thinking they can do that. But if you've got a 3-month wait, that applies to everyone. And so with a shorter waiting period, it's super easy. You don't have to think about hours or anything. You start with the original date of hire. If I've got a 3-month wait, you go to the 3-month anniversary date and you ask the question, is the person still employed on that day, that 3-month anniversary date? If the answer is yes, they're eligible. It doesn't matter if they work 1 day at the beginning of the period or 1 day at the end. They get what we call service spanning. So you count the intervening period. So you don't have to think about it any more complicated than original date of hire to the 3-month anniversary or the 6-month anniversary, if that's what your waiting period is, right? You're not counting hours in this case for shorter waiting periods. So let me see how we're doing on time. All right. Now, this gets to the point of excluding improper classes of employees, right? So you might have a plan sponsor that's excluding hourly employees from the 401k plan. That may or may not be permitted, but the plan document definitely has to have the language in there that says, I'm excluding hourly employees, right? And generally speaking, you're only allowed to exclude a certain amount of your employee population anyway, right? Like typically, you can only exclude 30% of your non-highlies. If you exclude more than that, then you run into some testing problems that you're not offering the plan to enough people. So another popular exclusion that we see, part-time, seasonal. The IRS does not like these terms at all, what we call service-based exclusion language, right? So I'm excluding a group of people and it's based on their service, right? They're part-time, they're seasonal. The IRS views this as a circumvention of the maximum 1 year waiting period, right? Because you can have a part-timer that meets the 1,000-hour requirement, and because you have this little exclusion language in your document, you're not covering them or offering them the plan, and the IRS has a big problem with that. So much so that these are new regulations that were passed as part of the Secure Act laws that were passed recently. So there are new long-term part-time employee laws or requirements that this is an entire webinar on its own. So I would go to our YouTube channel and watch the segment on that. But essentially, if you have the same part-time employees working for your company, so long-term, right? Like, and what the IRS defines as long-term is if you got a part-time employee that works between 500 and 1,000 hours, right? In 2 or more consecutive years, they're considered a long-term part-time employee. and you cannot exclude them, even if you have a 1-year wait in your plan, right? So they're not working 1,000 hours under the 1-year wait. You cannot exclude them anymore under this new law. So what I would say is, if you think you have people like that, like, again, part-time people working between 500 and 999 hours, right? In 2 or more consecutive years, I would call us. Please call your account manager. We'll help you review your census data and determine if you've got a problem or need to redesign your plan in some way so that you can avoid these new rules. So failure to include or exclude employees, just be aware of, again, what is my waiting, one of your primary jobs is letting your people in on time. So be aware of what is your waiting period. Make sure that your staff, whoever is determining who's eligible and when, knows how to calculate when they're eligible. And generally, I would say it's a good business practice not to exclude any classes of employees. Certainly don't do it if it's not in your document. So understand what's written in your document before you decide I'm not going to offer the plan to a particular class of employees in my company. So how do we deal? We get a lot of questions on how to deal with rehires. Okay, and so the rule is, if a formerly eligible employee ever had a single vested dollar in the plan at some point in the past, they never lose their prior service credits, okay? Otherwise, if they never had any money in the plan and they were never eligible, then they lose their prior service credits after 5 consecutive years. So what do I do if I have rehires that had money in the plan, right? They should be allowed into the plan. So they rehire, you let them into the plan immediately. They don't have to requalify under whatever waiting period you had. They don't have to wait till the next entry date if there's a later entry date. You should just offer them the plan immediately. So in general, I would say most rehires are going to fall in under the, are not going to have their prior service credits deleted or they lose credit for them, right? Because unless you're a firm that really routinely hires people that have been gone for 5 years, if it's less than that, they definitely come in again, right? They don't lose that service credit they had before. It's important to also distinguish, I kind of have described how initial eligibility calculations work. It's a little bit different for vesting, okay? So by law, for initial eligibility, you have to start with the original date of hire, and you have that kind of you've got that first computation period that crosses calendar years most of the time, right? For vesting, it's a little easier, and we do track the vesting for you. You don't have to do that part of it, but for vesting purposes, you look at the plan year. Most plans are calendar. So for a calendar year plan, you simply look at the calendar year, and if the person fulfilled the requirement of 1,000 hours generally, then they get 1 year of service credit. There's also this concept that once you're eligible, okay, so somebody could be eligible to contribute to the plan on an employee contribution basis. But if your plan is making an employer contribution that's an annual contribution, not a payroll by payroll, but annual, you can actually put rules in your plan that indicate that they have to be employed on the last day of the plan year, to get the employer allocation. So you can, even though they're otherwise eligible, you can actually exclude some of your terminated people from the employer allocation. And that can save the company some money. But again, it's only really for annual calculations and contribution funding. We find that most of our plans are payroll by payroll. If yours is, you don't really have to worry about this. I'm only putting this out there because there's all these different service crediting rules, and And the more you know about it, the easier it is if you get questions from your employees. So loans are very popular in 401k plans, but they come with some rules. All right, so there's a maximum dollar amount. They have to follow very specific payment schedules that are amortized. So one of the biggest problems that we see when we're fixing loan problems is that a participant takes a loan, somebody in payroll or administration misses the fact that they did that, and they don't get the repayments started on time, right? Because we'll go through some of the loan rules, but that can be a problem, right? It's kind of like a loan on your house, right? I mean, it's due the first of every month, and if you forget about it for 6 months, there's a problem. It's no different for a 401k loan. So there's a cure period. Basically, if the loan becomes delinquent, like I've missed payments, the IRS rule on that is that the loan has to be defaulted no later, either defaulted or fixed somehow, no later than the quarter following the quarter in which the first payment is missed. So if I miss a payment in the first quarter, I have until the end of the second quarter to either bring it current or otherwise fix it, So if that doesn't happen, the loan goes into default and the investment provider issues a 1099, which shows the loan is taxable. So loans are, a participant borrowing their own money. Even though money's coming out of the plan, it's not, if you follow all the rules, it's not a taxable distribution, and they get to repay it back to themselves over time. All right. What happens though when it goes into default? At that point, you've broken the rules, and the IRS wants it to be taxable. All right. Some of your investment providers, the Voyas and the Empowers of the world and so forth, will provide loan reports to you that might show loans that are behind or possibly in default, right? So, make sure you're paying attention to those. Others, also if a loan needs to be defaulted, some of them will default it automatically, and others need to be told to default the loan. So be aware of what your investment provider, how they handle loan defaults. Again, in Nova, we're trying to help you. Our distribution department, for some of the investment providers that don't do it automatically, we do some monitoring. We pull the reports too, and try to keep you up to date on who may or may not have a loan that's close to default. But you should be doing the same, because technically you're the plan administrator. So how do we fix a loan that's delinquent? There's a few different methods. You could either increase the deductions out of payroll to sort of catch the loan up, right? If you miss 10 payments, you could start making extra payments until you get back to a current state. The participant can always completely pay the loan back, right, to their account. That would solve the problem. Or it can be re-amortized, right, or refinanced, right? And that just ends up increasing the payment amount a little bit, but at least the loan will be paid off by the required maturity date. And that's the important thing. So if you miss the cure period, this still can be corrected, right? We can still use some of these techniques to fix it. But if we don't, then it has to be defaulted. How do we prevent these things? Just keep an eye out on your message centers from your investment providers. Again, a lot of them provide reports on loans, which ones are current, which ones are delinquent. Now, I will say one more thing, just to clarify. We're talking about actively employed participants. You're going to have people that terminate that have a loan. That happens all the time. What happens in that scenario is the loan should be defaulted by the end of the cure period. However, if the participant comes in and says, "Hey, give me my money. I want to roll it over. I want to, take a cash distribution," at that point, your investment provider, the normal practice is the loan will be defaulted upon the distribution. Whenever they take the distribution, it will get defaulted automatically in that situation. So you don't have to worry about those. Where we're really talking about people that are actively employed and you know, you're paying them and they have a loan outstanding that they're not making payments on. That's where I think your focus needs to lie, right? So pay attention to the message centers, you know, periodically compare some of these reports from the investment providers against your payroll records. Like, okay, here's a report that has all the loans that John Hancock shows. And then compare it to your payroll records to make sure that none of the you don't have an actively employed person that has no loan payments coming in, right? It's kind of self-audit yourself. Another big audit item for the Department of Labor in particular is sending in the employee contributions that come out of the payroll deductions on time. This is a big one not only for the Department of Labor, this is one of their biggest things they look for if they come in to audit you, but also if you're a large plan subject to an independent CPA audit, your CPA auditors that come in to look at things are going to look at that as well. Small plans have a different standard of what's considered late than large plans. So if you're a small plan that generally has less than 100 eligible people, there's a safe harbor time frame, which is 7 business days after the pay date. Okay, so you have 7 business days after the pay date to get the money over to the investment provider. This only applies to employee money, right? So your employee contributions, your loan repayments, it doesn't apply to the employer contribution. So if you're making a match, you know, you can do that later. Generally, if you're doing payroll by payroll, the match would go in at the same time, but you're not going to get penalized if for some reason the employer contribution goes in a little bit after this 7-day business standard. Okay. The Department of Labor also reserves the right, like if I had like 26 payrolls in a year and I was late on one, then they can revert you to this standard for the large plans. And the large plans say, get the money in as soon as administratively possible, but not later than the 15th day of the month following the pay date. You can forget the second bullet. That's meaningless to the Department of Labor. They want it in as soon as administratively feasible, which is a gray area standard. Generally, they are going to come in, if they audited you, they would come in to see how quickly you're doing other things, like how quickly does the withholding go in when you pay the government on a pay date, right? If you're doing that in 2 days, then that might be your standard for the employee contributions going to the plan as well, right? So it's not as clearly defined, but I can tell you from being in many Department of Labor audits for some of our clients, generally 3 to 5 business days is the max. And it could be shorter than that. So keep that in mind. What happens if they're late? If you have late contributions, then we have to fix the problem by making lost earnings calculations and then depositing the lost earnings in on behalf of the employees. There's also, you have to report them on the annual Form 5500, which can be an audit flag for the Department of Labor. And then there's also a 5330 excise penalty tax because late contributions are considered a prohibited transaction for a 401k plan. Now, the sad part about all of this is, NOVA can do these calculations, but they're fairly tedious, and we have to charge you more generally to do the calculation than the actual earnings will add up to. It's not uncommon to see earnings calculations where you have to deposit $200 or $300, and we had to charge you $1,000 to do the calculations, just because of how complicated the calculations are, the way the DOL wants them done. So better to just avoid the problem altogether. So again, just make sure you understand what your applicable deadline is and follow it, right? Am I a large plan, small plan, and set up procedures to ensure that they're made on time, and you've got a backup person in your payroll. Somebody goes on vacation or has sick leave, right? You've got a backup plan on how to get these contributions made. There are things called, some of you may have 360 connections. These are where there's an automatic process where the money is sent over automatically from your payroll system to your investment provider, right? That's the best possible deal, because it should be impossible to have late contributions if you're doing that. The downside is, in order to do that, you really have to set up this 360 connection and then, you know, supply all the data on everybody to the record keepers, the investment companies. Okay. The other thing is, be consistent. If you're going to say, I'm going to get these in 3 days, make sure all of them are getting in 3 days. You don't want some in 1 day and then 5 days and then 3 days, because the Department of Labor could come in and say, well, we've looked at the facts and circumstances, and it looks like most of your payrolls went in 1 day, so these ones that are 3 and 5 days we're going to consider late. They could do that. So you also want to make sure that you're depositing your money into the correct money type at the investment provider. So, for example, right, if you imagine your benefit statement that comes from the 401k plan, it has multiple line items, kind of what I call buckets of money. So the employee pre-tax deferrals are on a separate line item and have to be accounted for separately than the Roth contributions and the matching contributions. You know, why? Well, distribution requirements are different, let's say, and taxation requirements are different for pre-tax contributions than Roth, which are after-tax contributions, right? Some plan documents restrict withdrawals on you know, employer contributions like profit sharing and match. So if you can't be lumping them and commingling them all together. So it's very important. We do a lot of correction projects on what we call source correction. So a certain money type is commingled with another one, right? We've got the match going into the safe harbor match, for example, like discretionary match going into safe harbor match. Safe harbor match is 100% vested. Discretionary match is subject to the vesting schedule. If you commingle those two, people are going to get paid out wrong. So we have to fix those. And again, it's an hourly rate to get kind of expensive to fix that kind of a problem. Now, everybody, I think, is fairly familiar, but there are limits each year on how much employee money one individual can put into a 401k plan. All right, so for 2024, that number is 23,000. And so 23,000 if you're under 50 years old. If somebody is more than 50 or older, they can put in 30,000 at any time. So if they're going to be 50 or older at any time this year, they can put in 30,000, starting at the beginning. They don't have to turn 50. That's just their limit if they're going to be 50 at any time this year. This applies to Roth and pre-tax deferrals together, and it's a limit on the person, the individual. It's not a plan in general. All right, so you want to make sure that your payroll systems are set up properly to limit people based on their age. There's similarly a matching contribution limit if you're making a match. Now, not all, some plans have discretionary match and they don't fund any, but if you're actually making a match, there can be a limit, and it's because there is a cap on the total amount of compensation that we can legally count in the plan. So somebody can be making $1 million, like an executive, every year. And all of the limits and testing that we base the plan on are capped at $345,000 for 24. So how does this affect your match? If let's say you have a matching formula that's 50% or 6% of the first, 50% of the first 6% that somebody contributes. Well, that particular formula caps out at 3%, right? And if you just do the math, you take the 345 times 6 times 0.5, right? And you come up with a dollar amount, 10,000. And for that particular formula, the limit for this year is that no person should ever get more than $10,350 in the plan as a match, right? And if you don't input that limit into your payroll system and you have somebody making $500,000, it's going to overmatch them, right? So there should be a limiter in there to limit based on your formula. Different example, right? We have a lot of safe harbor plans. I'm sure there's quite a few of you that have safe harbor plans. The safe harbor formula is 100% of the first 3% and 50% of the next 2. That particular formula caps out at 4% of pay. So if you just take 4% of 345, if you're a basic formula safe harbor match, no one should ever receive more than $13,800 in the plan. Period. The end. If they go over that amount, we're going to have to, refund some of the money. Actually, what happens is you don't refund it back to the participant. You forfeit the excess to the forfeiture account, so they lose that part. The problem might be that if the person leaves before we do look for this for you, but the problem is we get your data once a year after the year closes, right? And somebody might have left before we can realize that there's an excess, and now your company is just out that money. Like if they took a full distribution and you put in 20,000 instead of 30,000, 13,800, and they took it all, it's very hard to get it back, and you probably won't. So again, just check your payroll system to avoid this problem. Make sure that you've got the appropriate dollar caps in place, and then make sure that the system, when it's calculating your matching formulas and everything else, that it adds the catch-up and non-catch-up together. You don't need separate fields for that in your payroll system. It should add those together and then apply all the formulas and so forth. Okay. These limits do change. The 345, for example, is only for 2024. The IRS does index those either up or down depending on inflation, and we send a notice to you at the end of each year on what the new limits are for the coming year, for the following year. So pay close attention to our correspondence on what the new limits are so you can update your payroll systems. A lot of them update automatically because the payroll companies know what these limits are too, but your job is to review that things are operating correctly in payroll. There are also a variety of notices that are due. I won't go through all of these, but at initial enrollment, there's a summary plan description. That's, again, the legal explanation of the terms of the plan in plain English for your participants. So when somebody becomes initially eligible, they should be getting the summary plan description. There are fee disclosures about the mutual funds that are in the plan. That notice comes from your investment providers. They typically will provide those in the enrollment kits. So you don't always have to worry about that one. But safe harbor notices and the SPD are not generally included in the enrollment kits that your investment providers give you. You would include those somehow, either inserting them yourself or getting them to the participants in another manner. All right. If you have an automatic enrollment plan, we didn't even talk about that too much, but there's a special notice for that. Annually, there's a summary annual report. We issue that along with the 5,500 when we send it to you for signature. So it covers the financial activity in the 401k plan for the year that passed, right? Annually, there are additional 404, every year you got to send out a 40485 notice, the fee disclosure. The safe harbor notices are generally required annually along with the automatic enrollment. Distributions, special tax notice, and that goes out to the participants. This one you don't have to worry about too much because this is always included by your investment provider in their distribution kits. So more information. And the final thing is your forfeiture account. So all of the, if you're making a discretionary match that's subject to a vesting schedule and somebody leaves, then the part that is not vested, they don't get to take with them, right? So let's say somebody was only 20% vested, 80% of their account would be forfeited, and it would go into this holding account that we call a forfeiture account. Those forfeitures can be used to either pay your plan expenses, your routine plan expenses, okay? They can be used to offset your ongoing employer contributions. So if for one pay period your match was going to be $10,000 and you had a couple thousand sitting in the forfeiture account at John Hancock or Voya. There are ways to, when you send in the funding itself, you can say take 2,000 out of the forfeiture account, then these organizations will ACH your bank account for 8,000 and then have it add up to the. So you want to be making sure that you're reducing and using up those forfeitures. You don't want them to just build up. I just had a client that got audited, and the IRS penalized them $12,000 for not following the terms of their plan document because they were not reducing their forfeiture account or not using up their forfeitures regularly. They'd been building for like 10 years, So the one thing you definitely don't ever want to happen is have money come out of the forfeiture account back to your company as the employer. That's a prohibited transaction. I think we're done. I don't know if there are any questions at the moment.
Looks like we have one. Question is, could the forfeiture be used to fund lost earnings on like deposits?
Because the lost earnings are what we call it's a mistake, right? It's not really a routine expense. Generally, the answer is no on that one. So forfeitures can be used to pay, if you're a large plan, pay your audit fee. If you're being billed by Nova, that's certainly a routine expense. You can pay that. But things that are either mistakes and or discretionary expenses generally cannot come out of the forfeiture.
Okay, looks like that's the only one we have, so I can go ahead and wrap up the session. Just a few reminders, if you go on your go-to panel, you're going to see a drop-down for handouts where you will be able to find a copy of today's presentation in PDF form. If you're not able to see this on your panel, you can email us and we'll send you the handout. For CE credit, be sure to stay until the pop-up survey once the session ends. For any other questions, please be sure to email us, webinars@nova401k.com. If you have any questions for Steve, his email is on the screen at the moment, or you can email us and we can forward that over to him. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates. Thank you so much, Steve, for sharing your time and your knowledge with us today. And thanks again to everybody for joining. We hope you have a great day. Bye.